Hello everyone, welcome to another video on our personal financial series. Today we will be looking at mutual fund as a wealth creation vehicle. What is mutual fund? A mutual fund is a type of investment vehicle that pools money from many investors to buy a diversified portfolio of assets, such as stocks, bonds, money market instruments, or other securities. A mutual fund is managed by a professional fund manager or a team of analysts, where each investor owns units, or shares, of the mutual fund, representing a portion of its total holdings. For example, if a mutual fund is worth $10 million and you invest $1,000, you'll own a small fraction of the total portfolio based on the current net asset value per unit. So how does mutual funds work? 1. Pooling money. Investors contribute money to a common pool. 2. Professional management. A fund manager uses this pool to buy a variety of assets following the fund's objective. For example, equity funds invest in stocks, debt funds invest in bonds or fixed income securities, or hybrid funds mix both. 3. Diversification. Because the fund invests in many securities, your risk is spread out, i.e., if one stock performs poorly, others might perform well. 4. Earnings. You can make money from a mutual fund in 3 ways: dividends, interest. If the fund earns income from its investments, it may distribute it to investors. Capital gains. If the fund sells an investment for more than it paid, you may receive a share of that profit. Net asset value appreciation. The value of your fund units increases as the portfolio grows. 5. Redemption. You can sell, redeem, your mutual fund units at the current net asset value. For open-ended funds, you can do this anytime. Close-ended funds have a fixed maturity period. Let's look at the types of mutual funds. We have equity funds, which focuses on stocks and has higher risk and higher return. Debt funds invest in bonds or money markets and it's generally lower risk. Balanced, hybrid funds, mix of equity and debt. Index funds, tracks a market index, e.g., S&P 500. And sectoral, thematic funds, invest in specific sectors like tech or healthcare. Okay, let's look at some pros and cons of the mutual fund. Key advantages of investing includes: diversification, reduces risk. Professionally managed, liquidity, easy to buy, sell. Suitable for beginners. Disadvantages: management fees, expense ratio. Market risk, value can go down. No guaranteed returns. Choosing the right mutual fund depends on what you want your money to achieve. Therefore, we must evaluate the following steps. Step 1. Identify your financial goals. Whether short-term, 1 to 3 years, e.g., emergency fund, vacation, buying a gadget; medium-term, 3 to 5 years, e.g., car purchase, business capital; or long-term, 5+ years, e.g., retirement, house, children's education. Your goals, timeline and risk tolerance will guide the type of fund to choose. Step 2. Match goals with fund types. Short-term 0 to 3 years debt funds, liquid funds, or money market funds; low risk level, medium-term 3 to 5 years. Balanced, hybrid funds, mix of equity and debt, moderate risk level; and long-term 5+ years equity funds or index funds, high but higher return potential. Tip: the longer you invest, the more risk you can take, because time helps smooth out short-term market fluctuations. Step 3. Know your risk tolerance. Ask yourself, how comfortable am I with market ups and downs? Low-risk investors, right pointing arrow, choose debt or balanced funds. Moderate risk investors, right pointing arrow, choose hybrid or large cap equity funds. High-risk investors, right pointing arrow, go for small, mid-cap equity funds for higher returns. Step 4. Check fund performance and ratings. Before investing, research past performance, 3 to 5 years trend, not just recent months. Expense ratio, lower equals better returns for you. Fund managers experience, Morningstar or CRISIL ratings, look for 4 to 5 stars. Step 5. Choose your investment method. Lump sum, invest all at once, best when markets are low. SIP, Systematic Investment Plan, invest monthly, great for beginners and consistent wealth building. Example: if your goal is to retire in 20 years, you can start a monthly SIP in a diversified equity fund or index fund. Reinvest dividends. Gradually shift to safer funds, like debt funds, as you approach retirement. Summary: match fund type with goal, duration and risk level. Review fund performance, cost, and manager history. Stay invested long enough for compounding to work. Use systematic investment plans for consistency and discipline. Thank you for watching. See you in our next video.